Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. In this video, we'll be going over A-Level Accounting 2023 October-November paper 1-3. This is the multiple choice paper which consists of 30 questions. Each of them will be of 1 mark and the total time limit given for this paper is 1 hour. So in this video as well, we'll be attempting to complete this paper under 1 hour. Without any further delay, let's get started. For the first question, inventories are valued at the lower of cost and net realizable value in the statement of financial position. Which accounting concept is being applied? Since we're talking about inventory, this is our current asset, right? And we are valuing it at the lower of cost and net realizable value, which means that we want our asset to be as low as possible so that it is not overstated. So the accounting concept that is being applied in this case is going to be prudence, which is given by option D. For question number 2, which statements describe ways in which the security of data can be ensured within a computerized accounting system? Okay, so the first statement is avoiding the use of updates from the accounting software provider. Now, updating our accounting software will not have any impact on the security of the data, right? So statement 1 is obviously incorrect. The second one is frequent backing up of all work entered into the accounting system. So if we back up our data, it means that the security of data will increase so that if there are any sort of power cuts, then the database on which we are currently working won't be altered at all because we have the backup of all the work required for that particular database, which means that the second statement will be correct. The third one is making sure that the antivirus protection is put in place. Again, antivirus will protect our accounting system from any sort of viruses, which means that the security of data will be maintained. So statement 3 is also correct. And the fourth one is using a single password to allow access to the entire accounting system. So if you only use a single password, it means that any hacker could guess a single password correctly and get access to the entire accounting system. But if we maintain different set of passwords for each of our accounts, it means that it will take a lot longer for any outside parties to get access to our entire accounting system, right? So the statement 4 will be incorrect in case of security of data. The correct answer we're looking for should contain 2 and 3, which is given by option C. For the third question, on 1st January, Anne owed Sam 400. She paid the amount due on 6th January after deducting 2% cash discount. How did Anne record this? Okay, the first thing that we need to do is figure out the discount amount. That's 2% of the original amount of 400. So 400 times 2%, which will result in 8. And in this case, we're looking for the entry done in Anne's books of account. In this case, Anne owed Sam 400. So now Anne is paying to Sam, right? So Sam is the receiver in this case, which means that Sam's account should be debited with the correct amount of 400. So that's the total amount, including the discount as well as the amount that was actually paid. Then, since Anne is recording it and Anne is paying to Sam, in this case, the discount that Anne is getting is the discounts received, not the discount allowed. So the credit side entry will be the same amount of 400, but that will be recorded under 2 different headings. So 8 will be our discount allowed, which means that the amount that was actually paid through check will be the difference. So 400 minus 8, which results in 392. So the credit entry will be bank with the amount of 392 and the discount received with the amount of 8. So that the debit side as well as the credit side total will be 400. So this is the correct answer we're looking for, which is given by option D. For question number 4, an improvement to business premises has been incorrectly treated as an expense in the financial statements. What is the effect on the financial statements after this error has been corrected? Okay, so the error in this case is improvement to business premises. And remember, improvement to the non-current asset is not the day-to-day activity of a business, which means that this is a non-recurring activity. So this should have been treated as our capital expenditure. But it was incorrectly treated as an expense in the financial statements. If we're talking about expense, that will be recurring in nature, which means that rather than treating it correctly as part of our capital expenditure, we treated it as revenue expenditure in our financial statements. Now we need to figure out the effect on the financial statements. Let's first talk about the effect on assets. So the correct entry would have been entering it as a capital expenditure. And a capital expenditure means that this would have been added to the cost of non-current asset, right? Which means that the non-current asset is now understated. But we're looking for the effect on the financial statements after this error has been corrected. So if the understatement is now corrected, it just means that our total non-current asset will increase. So for assets, we're looking for increased, which is given by C and D. Then we have profit for the year. Okay, so right now we have entered this capital expenditure as part of an expense, which means that we treated it as an overhead, right? So overhead was included, which was overstated. And we're looking at the impact on profit after this has been rectified. So if the overhead was previously overstated, we now decrease the overhead. And remember, overhead and profit have inverse relationship. So if the overhead is being decreased, it just means that profit will now increase. So for profit, we're looking for increased, which is given by B and D. So the correct answer for both assets as well as profit for the year is given by option D. For question number 5, a business incurs the following business expenditure during the year. We have the purchase of a machine. So purchasing a machine will be our capital expenditure because that's not the day-to-day activity of the business, which is why it can be classified as non-recurring event. Then we have the 3-year maintenance. So maintenance will be done for 3 years. So that's a frequent event, which means that this will be treated as our revenue expenditure. So this 10,000 will be entered as part of the overhead in the statement of profit and loss for those 3 years. It will be divided equally among those 3 years. We then have replacing the wheels of a motor car. So in this case, we are maintaining our motor car by introducing new wheels so that it can operate smoothly, right? So this can also be categorized as part of the maintenance. This is not any sort of improvement. Remember the difference between improvement and maintenance. That will make it easier for you to categorize it as revenue expenditure or capital expenditure. If we're talking about maintenance, it will be revenue expenditure, which is the replacement of wheels in this case. But if we're talking about any sort of improvement, then we have to categorize it as capital expenditure. The next one we have is upgrading the hardware of a computer. So upgrading can be understood as improvement to the existing hardware of a computer. That is why this should be classified as capital expenditure. Now we need to figure out the total cost to be included in the non-current assets account during the year. So it just means that we have to figure out the total of the capital expenditure. In this case, that's 9,700 plus 5,600, which results in 15,300. That's the answer we're looking for, which is given in option A. For the 6th question, what is the reason for providing for depreciation of non-current assets? Remember, the main reason to provide depreciation is so that the cost of using those non-current assets during the year can be properly matched to the revenue earned by the users of such non-current assets. Because remember, we do not put the entire cost of non-current asset as part of our overhead, which is why we divide it over the useful life so that the cost of using the non-current asset in each year can have a matching effect on the revenue earned by the users of such non-current assets. So that's the answer we're looking for. The first option is to ensure non-current assets are replaced when they are worn out. So provision of depreciation has nothing to do with introducing new non-current asset once the existing non-current asset have been worn out. So option A is incorrect. The second one is to match the cost to the revenue earned each year by the non-current assets. So this is the answer we're looking for. Let us go over the remaining options as well. To provide funds for purchasing replacement non-current asset. Remember that depreciation is a non-cash expense, which means that there will be no accumulation of funds by providing for depreciation so that we can purchase the replacement non-current asset. So option C will be incorrect. Then the fourth one is to show the amount they would realize if non-current assets were sold. Again, we are talking about depreciation, not disposal. So this has no correlation to provision for depreciation. Option D will be incorrect as well. For the 7th question, a business uses the straight line method of depreciation. A machine which it has owned for 3 years has a carrying value of 13,000 at the end of the 3rd year. When purchased, it was estimated that it had a life of 5 years and a residual value of 5,000. What was the original cost of the machine? So remember that we are utilizing straight line method. We have been given the residual value of 5,000 as well as the useful life of 5 years. So the depreciation charge per year would just be cost minus our residual value of 5,000 divided by the useful life of 5 years. And this would just provide the depreciation charge for 1 year. But in this case, we have been given the carrying value of 13,000, right? And we're trying to figure out the cost. So let us utilize the equation. The net book value should be equal to our cost minus the accumulated depreciation. And the accumulated depreciation is just the depreciation charge multiplied by 3, right? Because this machine had been used for 3 years. This will be the accumulated depreciation. So we can just input this into this equation. And the net book value is just the carrying value, which is given as 13,000. So 13,000 will be equal to cost minus 5,000 divided by 5 times 3. Okay, let us solve this equation now. So that's 13,000 equals to 5 times cost minus, so the minus will impact both of these values. So for cost, this will be negative, but there's a negative and negative for 5,000. So that's plus 5,000. And for this one, we also have to multiply 3. So that will be 3c plus 5,000 times 3 is 15,000 divided by 5. Let's move the 5 to the other side. So 13,000 times 5 will be equal to 5c minus 3c, which is 2c, plus 15,000. So 13,000 times 5 minus 15,000 will be equal to 2 times cost. Okay, so this just means that the original cost of the machine will be 13,000 times 5 minus 15,000 divided by 2, which results in 25,000. So this is the correct answer we're looking for, which is given in option C. For question number 8, Sammy paid a credit supplier 190 in full settlement of a debt of 200. It means that there was a discount. Discount is the difference between the full debt and the amount that was paid. So 200 minus 190, which results in 10. He omitted to record the discount. How did correction of this error affect Sammy's statement of financial position? So we're only looking at the statement of financial position in this case, not the statement of profit and loss. So the first impact we're looking at is for bank account. So remember that the amount that was paid was 190, which means that the same amount would be recorded in bank. So even after the correction, there would be no correction required for the bank account itself. So there will be no effect, which is given by C and D. Now for capital, we didn't record the discount, right? And since this was the discount received while paying a credit supplier, this is the discount received we're looking at. And if the discount received was not included, then it just means that our profit for the year was understated because we did not include this income, right? And remember, the profit for the year will always be added to capital. So the same impact will be present for capital. So capital was also understated. Now, after correcting this error, our capital will increase, right? That is given by option D. Now we're looking at the impact on trade payables. And remember, the trade payables included the credit purchase of 200, right? But we only recorded the payment of 190 instead of the entire amount of 200. So 10 was still present as part of the trade payables, which means that our trade payables was overstated previously. Now, after correcting this error, the trade payables would decrease, which is given in option B and D. So the correct answer for all three headings, bank, capital, and trade payables, is given by option D. For question number 9, the trial balance of a business did not agree and a suspense account was opened. The following errors were then discovered. Okay, we need to figure out the opening balance in the suspense account. So whenever we're trying to figure out the opening balance in the suspense account, it will be easier if you first rectify the errors within the trial balance and then post it in the relevant side of your suspense account. Okay. The first error is that the sales journal total of 9,150 had been credited to both the sales account and the sales ledger control account. Okay, so remember that the sales ledger control account can basically be understood as our trade receivables account, right? And within the sales ledger control account, we always include the sales value on the debit side. But instead, in this case, we have credited it to the sales ledger control account as well. This will understate our trade receivables value, right? So instead of entering it on the correct side, we entered it on the opposite side. And whenever we encounter errors where it has been entered on the opposite side, we need to enter the same amount on the correct side twice, so that once it gets cancelled out with the incorrect entry on the opposite side, and once it shows the correct balance on the correct side, which is why now we need to include 9,150 twice on the correct side for trade receivables, and that would be on the debit side itself, right? So that would be 9,150 times 2, which results in 18,300. and the correct side would be debit side. Now, the rectification of this error on the suspense account will go on the opposite side of that of the trial balance. So 18,300 will be recorded on the credit side within our suspense account. Then the purchase journal total of 3,450, that's the correct amount of purchase, had been entered correctly in the purchases account, but as 3,350 in the purchases ledger control account. So again, the purchases ledger control account can be understood as our trade payables account, and in this case, it had been understated because the correct value is 3,450 and we only entered 3,350. So the trade payables has been understated by 100. So we just need to enter the correct amount of 100 on the correct side for trade payables. And since we're talking about liability in this case, it would be recorded on the credit side within our trial balance. So 100 goes on the credit side. Now the rectification of this error on the suspense account would be 100 on the debit side. Then motor expenses of 6,450 paid by check had only been entered in the bank account, but we also need to show this as our overhead under the heading of motor expenses, and any expenses will be recorded on the debit side in case of our trial balance. So we just need to enter the correct amount of 6,450 on the debit side as the motor expenses. Now the rectification of this error within our suspense account would be 6,450 on the credit side. Okay, now we can figure out the opening balance. We first need to figure out the total of the heavier side, which clearly is the credit side in this case. So that's 18,300 plus 6,450, which results in 24,750. Now the opening balance is the balancing figure on the debit side. That will be 24,750 minus 100, which results in 24,650. And since this is the debit side, the correct answer we're looking for is 24,650 on the debit side, which is given by option D. Now for question number 10, which items are used to update the cash book when preparing a bank reconciliation statement? So any entries that have already been made on the bank statement but yet to be made within our cash book will be updated in the cash book when preparing a bank reconciliation statement. Those are the items we're looking for. The first one is an amount directly collected by a supplier from the business's bank account. So bank account has already recorded it, but we are yet to record it in the cash book. So this is the item we're looking for. The second one is an amount directly transferred by a customer to the business's bank account. Again, this was directly transferred to the business's bank account without giving any cash to the business, which is why we need to now update it within our cash book. So that's also correct. The third one is an amount not yet credited to the business's bank account. So we credit all of our incomes, right? So these are the outstanding deposits, and outstanding deposits will only be adjusted within the bank reconciliation statement itself, not the cash book. So this is incorrect. Then we have an amount not yet debited to the business's bank account. So the debit side will be all of our expenses, which means that these are the unpresented checks. Now again, this will only be adjusted within the bank reconciliation statement, not the cash book itself. So the correct answer we're looking for should have 1 and 2, which is given by option A. For question number 11, the year-end balance in the cash book was 23,780. This was different from the balance on the bank statement. The difference was due to the following items. We need to figure out which figure should be included as cash at bank in the statement of financial position. Alright, so we have the cash book balance. Now we just need to adjust the entries that have already been made on the bank statement but not yet made within our cash book. So we start with the amount of 23,780. Then there was a bank error, meant a check was incorrectly debited to the bank account. So if this is a bank error, it means that it will only be adjusted within the bank statement, not the cash book. We can completely ignore this. The second one is a customer's check which was dishonored. So dishonored means that previously we recorded 1,375 as part of our income, but we actually didn't receive it. So that is why we now have to remove it from the income. Previously we added it, which is why now for removing, we need to subtract the same amount of 1,375. Then we have bank charges. So bank charges will be automatically recorded within our bank statement, but we have to record it into our cash book again. And remember, this is also an expense, which is why we subtract the 216. This will give the value of 22,189. This is the correct answer we're looking for, which is given in option B. For question number 12, which item is not recorded in the sales ledger control account? We have allowance for irrecoverable debts. Remember, we only include the irrecoverable debts itself, not the allowance for irrecoverable debts. So our correct answer will be option A. Then let's take a look at the remaining options as well. We have dishonored check, which will be recorded on the debit side. We have returns inwards, which will be recorded on the credit side. And we have the settlement discount, which will also be recorded on the credit side. For the 13th question, the closing balance of a purchase ledger control account was 7,480. It did not agree with the total of the supplier's balances in the purchase ledger. The following two errors were found. Okay, we need to figure out the corrected balance of the purchases ledger control account. So we just have to prepare the purchases ledger control account in this case. And since this is basically the trade payables account, this is a liability account, which is why the opening balance will always be on the credit side. So 7,480 on the credit side. Then an error of original entry occurred when a credit note from a supplier for 120 had been recorded as 210. So the credit note can be understood as purchases returns. So purchases returns was of 120, but it had been recorded as 210. So purchases returns was overstated. So 210 minus 120, it results in the value of 90. And normally purchases returns would be recorded on the debit side, right? But since we're talking about overstatement, we need to remove 90 from the purchases returns, which is why we need to enter this amount on the opposite side. So that will go on the credit side. Then interest charged on an overdue supplier's account of 40 had been debited to the purchases ledger control account. Remember, the interest charge will always be credited in this case because this is the amount that we have to pay to the supplier, right? And since previously it had been entered on the opposite side, rectification requires entering the same amount twice, so that once it gets cancelled out with the previous incorrect entry on the opposite side, and once it shows the correct amount of our interest charged. Okay, let's figure out the total of the credit side. That's 7,480 plus 90 plus 40 plus 40, which results in 7,650. So our closing balance will also be 7,650. That's the corrected balance of purchases to control account, which is given in option D. Now for question number 14, which statements are correct? The first one is an increase in allowance for irrecoverable debts increases profit for the year. Remember that the increase in allowance for irrecoverable debts is expense. And the expense and profit for the year has an inverse relationship. So if there is an increase in expense, the profit will decrease, not increase. So statement 1 is incorrect. Then irrecoverable debts decrease profit for the year. That is correct because irrecoverable debts is also treated as expense. So if the expense increases, then the profit for the year will decrease. The third one is rental income received in advance at the end of the period will increase profit for the year. And remember that this is the rental income received in advance at the end of the period, which means that this will be subtracted while calculating the actual rental income for the year, right? And if the income is being subtracted, it means that the profit for the year will decrease because income and profit has a proportional relationship. So if one increases, the other also has to increase, which is why statement 3 is incorrect. Then revenue which has been earned but not yet received will increase profit for the year. So this is basically outstanding income, and outstanding income will be added because we have already earned it but not yet received, which means that this will be added while calculating the revenue for the year. And again, we're talking about an income. So if the income increases, it means that the profit for the year will also increase. So statement 4 is correct. The correct answer should include 2 and 4, which is given by option D. Now for question number 15, a business paid an annual rent of 24,000 at the beginning of the year. On 1st January, there was accrued rent of 4,000. Rental payments during the year is also given. So 1st January we paid 12,000, 1st July we paid 10,000, and 1st September we paid 13,000. Now how was rent recorded in the financial statements at 31st December? We first have the statement of profit or loss. Remember that within our statement of profit or loss, we only include the annual rent value, right? Because accrual concept is applied while preparing statement of profit or loss, which is why we have to adjust the opening and closing accrual as well as the prepayment value to the actual amount received. And in this case, we have the annual rent itself, so that will be 24,000 for statement of profit or loss. Then for other receivables, we first have to calculate the actual rental payments during the year. And in this case, we have the opening accrual as well. So this is the rental expense for the previous year, but we are yet to pay for it, right? And the total payments are here. Let's calculate the total. That's 12,000 plus 10,000 plus 13,000, so 35,000. Now out of 35,000, 4,000 was the rent paid for previous year. So the total payment made during the year is 31,000. So out of 31,000, 24,000 is the rent for the current year. The remaining value will be prepayment. So prepayment is 31,000 minus 24,000, which is also 7,000. So 7,000 was paid in advance by the business, which means that the business is yet to receive the services for these 7,000 paid. So this can be categorized as other receivables, 7,000. And there will be no other payables in this case because we don't have any accrued rent at the ending date. So for other payables, it will be nil. The answer we're looking for should be 24,000, 7,000 and nil, which is given by option A. Now for question number 16, a business adds a markup of 25% to all goods sold. The following information is available for the year ended 30 June. We have the receipts from credit customers, opening trade receivables, closing trade receivables, cash used for business expenses and drawings, discount allowed to credit customers, and the closing cash balance. Receipts from cash sales were used to pay business expenses and drawings. Any remaining cash was placed in the cash account. The opening cash balance was nil. We need to figure out the value of total sales for the year. Okay, so in this case, the total sales will be the cash sales plus the credit sales. Let us first calculate the credit sales. For our credit sales, we always start with the amount that we received from the credit customers, which is given right here, 284,300. Then we adjust the opening and closing trade receivables. We always subtract the opening trade receivables because these are the credit sales made in the previous year which are yet to be paid, which is why we need to exclude it. Then we always add the closing trade receivables, which is 26,500. And this is done because these are the credit sales made in the current year for which we are yet to receive the payment. So we still need to include this value as part of the credit sales. Then the discount allowed to credit customers should also be added. Because remember, within the statement of profit or loss, we first include the sales, then subtract the discounts allowed later on. So for it to be subtracted, we first have to include it as part of the total sales value. This gives the total of the credit sales to be of 289,900. Now we need to figure out the cash sales. So for cash sales, it would be easier if we prepare a cash book. Okay, so remember we were told the opening cash balance was nil, right? And we were told that receipts from cash sales were used to pay the business expenses and drawings, and any remaining cash was placed in the cash account. So we have the closing cash balance right here. Opening is 0, so closing will go on the opposite side as 500. Then we're trying to figure out the cash sales. That would be a receipt. So any income will be added on the debit side and any expenses would be included on the credit side, right? So the sales, cash sales is our income. We're trying to figure this one. This will be our balancing figure. Then the cash used for expenses and drawings is right here. These are the expenses which will go towards the credit side of our cash book, 52,400. Okay, let's figure out the total for the heavier side, which is clearly the credit side. 52,400 plus 500 results in 52,900. And that will be the amount for our cash sales. Now let us figure out the total. That's 52,900 for cash sales and 289,900 for credit sales. This results in the value of 342,800. That's the value of the total sales, which is given in option C. For question number 17, a partnership agreement only provides for interest on capital at a rate of 6% and interest on drawings at a rate of 8%. What will be the interest payable on a loan from a partner? So if the partnership agreement has no provision for the interest payable on a loan from a partner, then it means that the interest payable will always be at 5%, and that is given by option B. For question number 18, L and M are in partnership. The following information relates to the financial year. We have drawings, interest on drawings, interest on partner's loan, salary, as well as the residual profit share. We need to figure out what was the profit for the year. Okay, so basically we have to prepare an appropriation account. We first start with profit for the year, right? We're trying to figure this out. Then we first have interest on drawings. Now, interest on drawings is something that the partners will pay to the partnership, which means that this amount will definitely increase the residual profit. So we add the 1,200 and 1,800 for interest on drawings. Then we have the interest on partner's loan. So interest on partner's loan will already be adjusted while calculating profit for the year. So we do not have to account for it. Then we have salary, which will be paid by the partnership to the partners, right? Which is why this will reduce the residual profit share. We need to subtract the 20,000. And this will give our residual profit share. Let us first figure out the total. That's 36,000 plus 18,000, which results in 54,000. Now we just have to solve this equation. So profit for the year plus 1200 plus 1800 minus 20,000 is equal to 54,000, which means that profit for the year will be 54,000 minus 1200 minus 1800 plus 20,000, which will result in the value of 71,000. This is the answer we're looking for, which is given by option A. For question number 19, which items will not form part of the equity of a limited company? So equity will include share capital, share premium, revaluation reserve, general reserve, and retained earnings. And since we're looking for items that do not form part of the equity, we're looking for anything other than these 5 items. The first one is long-term bank loan, which is not a part of equity. So this is correct. Then we have share premium, which is part of the equity. So incorrect. Retained earnings is also part of the equity. So incorrect. And revaluation reserve is also part of the equity. So incorrect. Now the correct answer should only include one, which is given by option B. For question number 20, which is an internal stakeholder? So internal stakeholder will be directly related to the day-to-day operations of the business. Now, the first option is bank. So bank is not really invested in the day-to-day operations of the business. They will only be providing external sources of finance. So this is incorrect. The second one is debenture holder. Now, debenture holder is also the external party which will only provide the debenture for the company. It will again provide the external sources of finance, which is why this is not an internal stakeholder. The third one is employee. So employee is definitely invested in the day-to-day operations of the business, right? Which is why we classify these as an internal stakeholder. That's the correct answer. And the fourth one is potential investor. So potential investor again is not involved in the day-to-day operations of the business. That is why this is an external stakeholder. Now for question number 21, in the last financial year, R Limited had sales revenue of 190,000 and operating expenses of 108,000. In the current financial year, the directors think that if they increase spending on advertising by 5,000, then sales would increase to 205,000. Operating expenses, excluding advertising, would increase by 7,000. What would the operating expenses to revenue ratio be if the additional advertising took place? Okay. So the operating expenses, this excludes advertising, right? So we start with the previous operating expenses of 108,000. This would increase by 7,000. And there's also additional advertising of 5,000. So the total operating expenses would be 120,000. Now we need to figure out the operating expenses to revenue ratio. Okay. So operating expenses in this case is 120,000. And the new revenue is 205,000 multiplied by 100%. This will result in the value of 58.54%. This is the answer we're looking for, which is given in option B. Now for question number 22, the following information is available for a business. We have total purchases, credit purchases, opening inventory, closing inventory, total sales, all on credit, carriage inwards, and return outwards. Okay, we need to figure out the inventory turnover in days. So inventory turnover is just average inventory divided by cost of sales multiplied by 365. Let us first calculate the average inventory. We have the opening inventory and closing inventory right here. And average inventory is opening inventory plus closing inventory divided by 2. The opening inventory is 60,000, closing is 80,000. So 60,000 plus 80,000 divided by 2, which will result in 70,000. So 70,000. Now we need to figure out the cost of sales as well. So cost of sales is opening inventory plus purchases minus purchase returns plus carriage inwards minus closing inventory. Okay. So the opening inventory is 60,000. We have the total purchases of 820,000. There is no Okay, there is purchase returns outwards right here. So minus 40,000. Then we have the carriage inwards of 20,000. And we have the closing inventory of 80,000. And we do not have to use the credit purchases because this will automatically be included as part of the total purchases. So the cost of sales will be 780,000 times 365. This will result in 32.76. And remember, we always have to round it up when we are calculating days. So this will be 33 days. That's the answer we're looking for, which is given in option C. For question number 23, which characteristic describes an indirect cost? So the first option is a cost that cannot be controlled by company managers. So indirect costs are basically the fixed costs, and they can be controlled by company managers, which is why the first characteristic is incorrect. The second one is a cost that cannot be directly traced to individual cost units or cost centers. That is correct, because direct costs are those costs that can be directly traced to individual cost units and cost centers, and the opposite is true for indirect cost. So that's the correct answer. Let's take a look at the remaining options as well. A cost that changes at different levels of activity, that would be variable cost, which is part of the direct cost. So this is incorrect. Then the fourth one is a cost that remains unchanged at all levels of activity. Again, even though we are looking at indirect costs, these can change at certain levels of activity, right? Which is why the fourth characteristic will also be incorrect. For question number 24, the manufacturer of product type X incurs a specific cost. Data relating to this is as follows. So we have the units produced and the cost per unit. Let's calculate the total cost. Okay, for 6,000 units is 3 per unit, so that's 6,000 times 3, which is also 18,000. And for 9,000 units is 2 per unit, so 9,000 times 2, which is again 18,000. So no matter the level of units, we can see that the total cost will remain the same, which will only be true for fixed cost, and that is given by option A. For question number 25, a company makes a single type of product and sells it for 12 per batch. The variable cost is 4 per batch. Fixed costs have been absorbed based on a normal activity level of 1,000 batches at 3 per batch. What is the profit under marginal costing if the company makes and sells 1,500 batches? Okay, so first of all, we need to calculate the total fixed cost. And the fixed cost absorbed is 3 per batch for 1,000 batches. So that will just be 1,000 times 3. That's 3,000. Now, since we are operating under marginal costing, we first need to figure out the contribution. And the contribution per unit is the selling price minus the variable cost. So 12 minus 4, we need to multiply it by the number of batches, which in this case is 1,500. This results in a value of 12,000. Now, for the profit itself, we just have to subtract the fixed cost from our contribution. So the contribution in this case is 12,000. Fixed cost, we've calculated it to be 3,000, which results in 9,000. That's the answer we're looking for, which is given by option C. Now, for question number 26, a business operates a system of absorption costing. We need to figure out which statements are correct. The first one is overheads would be overabsorbed if the actual activity level was below the budgeted level. Okay, this is incorrect because remember that overheads will be overabsorbed only if the actual production, that's the activity level, is greater than the budgeted production. So statement 1 is incorrect. The second one is overheads would be underabsorbed if the actual activity level was below the budgeted level. This is true because underabsorbed will occur if our actual production is less than the budgeted production, and that's the criteria given in this case. The third one is overheads would be overabsorbed if the actual overhead exceeded the budgeted overhead. Okay, in this case we're talking about overhead. And again, overabsorption will occur only if the actual overhead is less than the budgeted overhead. But in this case, we have the actual overhead exceeded the budgeted overhead. So that's incorrect. And the fourth one is overheads would be underabsorbed if the actual overhead exceeded the budgeted overhead. Remember, underabsorption occurs if the actual overhead is greater than budgeted overhead. And that's the criteria given in this case, which is why the fourth statement is correct. So the correct answer should include 2 and 4, which is given by option D. Now for question number 27, a business uses an overhead absorption rate of 20 per direct labor hour. In April, budgeted direct labor hours were 6,000 and actual direct labor hours were 6,100. Overheads for the month were under-absorbed by 3,000. We need to figure out the actual overheads in April. Remember, the criteria we're given is under-absorption, which will occur if our actual overhead is greater than the budgeted overhead. And in this case, we're trying to figure out the actual overhead, right? So the under-absorption of 3,000 is the difference between actual overhead and budgeted overhead. And for budgeted overhead, remember that we need the hours to match so that the comparison can be valid for calculating over or under absorption. In this case, the budgeted direct labor hours were 6,000, but we need to apply the overhead absorption rate to the actual direct labor hours in order to calculate the budgeted overhead. So that will be 20 times 6,100, which results in 122,000. So the actual overhead in this case will be 3,000 plus 122,000, which results in 125,000. So this is the answer we're looking for, which is given by option D. Now for question number 28, which statement is an argument for using marginal costing? So we're basically looking for the advantages of marginal costing. The first one is international accounting standards require use of marginal costing. This is incorrect because absorption costing can also be used under international accounting standards. The second one is marginal costing data enables the use of decision-making techniques. That is true because we can compare make or buy situations as well as any shortage of resources. So option B is the correct one. Let's take a look at the remaining options as well. Setting selling prices is made easier under marginal costing because all costs are considered. This is incorrect because marginal costing has to divide the cost as variable or fixed. So not all costs are considered. Then the fourth one is the distinction between fixed and variable overheads under marginal costing is no longer relevant. That is incorrect because that's the major characteristic of marginal costing. Now for question number 29, the following information is available for a business. We have the total fixed costs, variable cost per unit, selling price per unit, as well as the break-even point. The business wants to reduce the break-even point to 1,500 units. Which strategy will not achieve the target break-even level? So always remember that break-even point, the formula is your total fixed costs divided by contribution, and contribution is just the selling price minus the variable cost. And in this case, we require the break-even point to decrease, right? So if the break-even point should decrease, it means that either the total fixed cost should decrease or the total contribution should increase. And for the total contribution to increase, either the selling price should increase or the variable cost should decrease. So the criteria that we're looking for in this case is the total fixed cost to decrease, the selling price per unit to increase, and the variable cost per unit to decrease. The first option is to increase the selling price to 22 per unit. And although the increment of the selling price to 22 would decrease the break-even point, we require it to be exactly 1,500. So let's calculate the break-even point. We have the 15,000 fixed costs. The selling price is 22, the variable cost remains at 12. This will result the break-even point of 1,500. And we're looking for the strategy that will not achieve it. Since this will achieve the 1,500 units of break-even point, option A is incorrect. The second one is reducing fixed cost to 12,750 and reducing variable cost to 11.50 per unit. Both the reduction of fixed cost as well as the variable cost will result in reduction in BEP. Let's calculate the new break-even point. That will be 12,750 divided by the previous selling price of 20 minus 11.50. This results in the break-even point of 1,500, which is why option B is also incorrect. Then we have reducing fixed cost to 12,800. Okay. So the break-even point in this case will be 12,800 divided by previous selling price of 20 and previous variable cost of 12. This results in 1,600, but we require the break-even point to be of 1,500, which is why option C will be the correct answer. Now for the 30th question, which assumption does not apply for cost volume profit analysis? The first one is all units produced are sold. That is the true assumption. The second one is only a single type of product is produced and sold. That is also the correct assumption. The third one is total fixed cost change over a period. That is incorrect because we require the total fixed cost to remain constant over a period, which is why option C will be the correct answer. Alright, this brings us to the end of paper 1-3. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.